Good afternoon, ladies and gentlemen. It's my pleasure to welcome you back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. And it's a genuine pleasure, as well as obviously an important event, to have the Honorable Jerome Powell, member of the Board of Governors of the Federal Reserve System, to speak to us today. His topic is recent economic developments, productive potential of the economy, and monetary policy. And it is that linkage between the real side productivity questions and monetary policy that I think Jay and his colleagues in the FOMC and many of us here at the Peterson Institute are very concerned with. There used to be a very simple translation that if you thought productivity was better, you would run a looser policy, and if you thought productivity was worse, you would run a tighter policy. It doesn't seem to be quite working out that way, but also because productivity is doing such strange and interesting things in the U.S. at this moment. So we're delighted to have Jay Powell with us. Just for bio, as all of you know, Jay took office as a member of the Board of Governors of the Federal Reserve in May of 2012. He was reappointed and sworn in June of 2014, and in theory, can serve until 2028. I say in theory not because of any doubts about his longevity or his commitment to public service. It is merely, as myself, someone who gave up on being on the inside after 3 years, a question of sanity. But more seriously, in obviously a very fractured political system here in Washington with a very fraught appointment process, Jay Powell has been a hero in standing up and staying and serving at the Federal Reserve under these circumstances and contributing importantly to many debates both on monetary policy and on financial regulation and bank supervision. Prior to being appointed to the board, Jay was a visiting scholar at the Bipartisan Policy Center in Washington, D.C., focusing on federal state fiscal policy issues. From 1997 to 2005, he was a partner of the Carlyle Group, and prior to that, he was an assistant secretary and even undersecretary of the Treasury under President George Herbert Walker Bush, with responsibility for financial institutions, the Treasury debt market, and related areas. He had previously had a distinguished career in the private sector as a lawyer and investment banker in New York City, but after this amount of time, we claim him as one of Washington's own. I hope that will not be misinterpreted in the press as something scandalous. That's meant as praise for someone who has put public service ahead of personal profit. I look forward to Jay's remarks. We will have on-the-record discussion and questions following. Jay Powell, thank you very much.
Thank you very much, Adam. It's great to be here today at Peterson, and I really appreciate the opportunity to speak here and thank those of you who came out. So I will begin by reviewing recent economic developments, and then I'm going to turn to supply-side considerations, such as the level of potential output and the potential growth of the economy. And I'll conclude with a discussion of monetary policy. As always, the views I express here today are mine and mine alone. On the state of the economy, the U.S. economy has improved steadily since the recovery began 7 years ago, with growth sticking right around 2%, oscillating around 2%, and our economy is now 10% larger than it was at its previous peak in 2007. Employment has now passed the 2008 peak by 5 million workers, and the unemployment rate has fallen from 10% to 5%, which is close to the level that many observers associate with full employment. Labor markets remain healthy, with employers adding roughly 2,000 jobs per month so far this year, a pace similar to that of the past several years. And here I will attempt to get a slide. There we go. So I'm going to go through a few slides as we talk. Job growth continues to be substantially faster than the underlying growth of the labor force, so the labor market continues to tighten. Despite the strong job gains, the unemployment rate has flattened out at 5% over the last 6 or 7 months, thanks to a welcome increase in the labor force participation rate, which you can barely see in the middle chart there. Meanwhile, there are tentative and encouraging signs of affirming in wages, seen most clearly in the data on average hourly earnings, the right panel, which are rising faster than inflation and productivity. All told, labor market indicators show an economy on a solid footing. Recent spending data, however, have been a bit less positive than the labor market data. Growth of personal consumption slowed notably in the first quarter. Business fixed investment has fallen now for 2 consecutive quarters, mainly but not exclusively because of a steep decline in energy-related capital expenditures. As a result, GDP over the 2 quarters ended March is now currently estimated only to have run at a rate of about 1% on an annualized basis. And that estimate may and probably will continue to move around as more data come in, including tomorrow. There are also good reasons to think that underlying growth is stronger than the recent readings suggest. Labor market data generally provide a better real-time signal of the underlying pace of economic activity. In addition, retail sales were reported to have surged in April, as did consumer confidence surge in May, suggesting that the pause in consumption may have been transitory. More fundamentally, stronger demand would be more consistent with an environment that remains quite supportive of growth, with low interest rates, low gas prices, solid real income gains, a high ratio of household wealth to income, healthy levels of business and household confidence, and continuing strong job creation. Indeed, current forecasts for second quarter GDP are for a rebound of around 2.25%. Inflation remains below the 2% target of the FOMC, with total inflation on a 12-month basis for PCE measured at 0.75% and core at 1.5%, both a little higher than a year earlier, but still well below target. Core, of course, has been held down by falling import prices, owing in part to the large rise in the dollar, as well as indirect effects of oil prices on core. As recent financial market tensions have eased, oil prices have increased, and the dollar has weakened a bit on net. So if oil prices and the dollar remain broadly stable, inflation should move up over time to our 2% objective. Inflation expectations, however, do seem to be under some downward pressure. Some survey-based measures are at the low end of their recent historical ranges, and market-based measures of longer-term break-evens have declined significantly since mid-2014 and stand near all-time lows. So while I see expectations as reasonably well anchored, it is essential that they remain so and that inflation return over time to our 2% objective. The easing in global financial conditions since mid-February and the associated waning in downside risks are, of course, welcome, and in part reflect expectations that the FOMC would move more slowly in removing monetary accommodation. However, the underlying risks will likely remain until global growth is on a stronger footing. Growth and inflation remain stubbornly low for most of our major trading partners. In China, stimulus measures should support growth in the near term, but may also slow China's necessary transition from its export and investment-led business model. Meanwhile, the ongoing buildup of debt there is notable, and there's also some remaining uncertainty about China's exchange rate policy. Elsewhere, risks are posed by the upcoming Brexit vote, ongoing pressures from refugee flows into Europe, and challenging conditions for emerging market economies such as Brazil, Russia, and Venezuela. Despite these downside risks, I see U.S. demand growing at a moderate pace, with the labor market continuing to heal, inflation returning over time to the FOMC's 2% objective. The economy is on track to attain the committee's dual mandate of stable prices and maximum employment. Now, we generally talk an awful lot about demand, and that's appropriate. So I want to take some time here to talk about supply-side considerations, which, of course, are more important over the longer term, albeit less to do with monetary policy. So turning to supply-side considerations, for several years after the crisis, economic activity remained far below its potential, and the need for highly accommodative monetary policy seemed clear. As the shortfall of output from potential has narrowed, supply-side considerations like the level and growth of rate of potential output naturally begin to matter more for policy. The tension that I mentioned a moment ago between labor market and spending data is not a recent phenomenon. Throughout the recovery period, forecasters have consistently overestimated both actual and potential GDP growth while underestimating the rate of job creation and the decline of the unemployment rate. To put the blue chip forecasters in the dock, This chart shows that for the years 2011 through 15, these forecasters every year overestimated growth and underestimated the amount of decline in the unemployment rate year upon year upon year. This next chart, I think, is even more interesting, frankly, and it shows, if you take just blue chip estimated the long-run potential growth of our economy in 2007 at 2.9%, and that has now declined to 2.1%, while also underestimating the more impressive than expected decline in unemployment. Other well-known forecasts shown here, such as that of the Survey of Professional Forecasters, the Congressional Budget Office, and yes, FOMC participants, followed pretty much the exact same pattern. And that pattern suggests that forecasters have only gradually taken on board the decline in potential in the wake of the financial crisis. Output growth can be decomposed into increases in hours worked and changes in output per hour or productivity growth. For the United States, much of the post-crisis decline in estimates of potential output growth appear to reflect weak labor productivity growth rather than damage to labor supply. And labor productivity has increased only 0.5% per year since 2010, the slowest 5-year growth rate since World War II and about 1/4 of the post-World War II average. For further perspective, productivity growth averaged 1.5% during what we used to call the slow productivity period from 1974 to 1995, and it averaged 3% during the tech boom decade from 1995 to 2005. So this shows that this is the familiar regime change chart, which shows that productivity has tended to go through high regimes and low regimes, and now it is at a very low regime for the last 5 years. Interesting also that the slowdown has been worldwide. This is all the OECD countries, all 30 of them, and you can see the red lines below there suggest productivity has been lower in this period than in prior periods. So given the global nature of the phenomenon, changes in factors specific to the United States are probably not the main drivers. I don't know if you have this experience, but I find that people tend to see U.S. economic developments through the lens of U.S. political events. And I find that when when a trend has sort of present throughout the globe, you have to really look beyond U.S. specific institutional factors. So what's causing this? One factor holding back productivity in recent years has been the meager growth of the capital stock, which I show here in Figure 4. This shows that capital deepening is at truly anemic levels. And in the view of the work we've done at the board, that weakness is consistent with and is well explained by the weak recovery in demand. Another important factor is the marked decline in total factor productivity, or TFP. And TFE, of course, TFP is that part of productivity that is not explained by capital investment or labor quality, and it's thought to be mainly a function of technological innovation, although the story's a lot more complicated than that. It may also be that the broad decline in dynamism in our economy across many, many measures of dynamism is contributing to lower TFP. Last thing I'll say about TFP is there is strong evidence that the slowdown preceded the financial crisis, particularly in sectors that use information technologies. This is the work of John Fernald and many others. The range of opinions looking forward on the future path of productivity growth is wide, and the historical record provides ample grounds for humility. What seems to have happened is a middle ground position has emerged that probably appears to assume that productivity is still being held down by cyclical factors and the lingering effects of the crisis, and that as those factors dissipate, labor productivity will move up from 0.5% perhaps to 1.5%, which would be the lower end of the long-run range. That seems to be the general assumption behind forecasts, and I can't really disagree with it. So in addition to productivity, the other principal factor in potential output is labor supply, which is determined by the working age population, the natural rate of unemployment, and the trend labor force participation rate. And both the natural rate of unemployment and labor force participation initially appeared to suffer crisis-related damage. More recent data, however, are, I would say, a bit more encouraging. Natural rate of unemployment reflects the matching of characteristics that employers are seeking with those of the unemployed. With the dramatic labor market dislocations of the crisis, it was not surprising to see measures of matching efficiency deteriorate, and many observers raised their estimates of the natural rate accordingly. But there are other factors like demographic change that have led to a decline and pushed the other way. And blue chip forecasters and many other forecasters now estimate the natural rate at around 5%, which is about where it was before the crisis, suggesting that these factors are roughly offsetting. Of course, estimates of the natural rate are famously and highly uncertain. Trends in labor force participation add another element of uncertainty. Participation in the United States has been declining since around the year 2000 and is estimated to have a trend rate of decline now of 20 to 30 basis points per year, driven by population, aging, and other longer-term trends such as decline in participation by prime-age males. But participation rate fell sharply after the crisis, much faster than its apparent trend, and it's been important to understand how much of that post-crisis decline is cyclical and thus amenable to repair by supportive policies, and how much is secular, due either to longer-run trends or to irreversible crisis-related damage. So it has been a relief to see the participation rate improve over the last 2 years relative to estimates of its trend. And indeed, in some estimates, participation is now close to its longer-run trend. Still, despite this relative improvement, the performance of the U.S. economy on this dimension has been poor relative to that of most OECD countries. For example, we experienced a decline in our prime age group participation of 2% between 2007 and 2014, while most OECD countries saw an increase. And the United States now stands at the low end of labor force participation for both men and women in that prime age group, above Italy, but well below Germany, France, and Spain. You can see here we are at the low end. There are different countries have different ways of calculating labor force participation, but I'm not aware, and I haven't been able to find anyone who would make the argument that there's a systematic overcounting of participation in those other countries. Maybe someone can do that here today, but I would say this is probably a real trend, and certainly if it is a real trend, it's not great news. Lower potential growth would likely translate into lower estimates of the level of interest rates necessary to sustain stable prices and full employment. So estimates of the long-run neutral federal funds rate have declined by about 100 basis points since the end of the crisis, and the real yield on the 10-year Treasury is currently close to zero, compared with around 2% in the mid-2000s. Of course, some of that will be negative term premia as well as expectations. So to sum up so far, estimates of the long-run potential growth of the U.S. economy have dropped from about 3% to about 2% in the wake of the crisis, much of that decline being attributed to slower productivity growth. The decline in realized productivity seems to be driven both by low capital investment that's well explained by weak demand and by lower TFP growth. Expectations of lower productivity growth going forward are more a function of slower gains in TFP. Lower potential output growth would mean that interest rates will remain below their pre-crisis levels even after the output gap is fully closed and inflation returns to 2%. Over time, our understanding of the relationship between recessions and supply-side factors has evolved. There's a growing body of work suggesting that recessions can leave behind lasting damage, especially severe recessions associated with a financial crisis. One recent analysis, Olivier Blanchard being one of the authors, along with Larry Summers and Cerruti, suggests that about 1/3 of the time there is no permanent supply-side damage. About 1/3 of the time there's a reduction in the level of potential output, but not its subsequent growth rate. And about 1/3 of the time there's a reduction both in the level of output and in the subsequent growth rate. Unfortunately, as this chart shows, recent experience suggests that the United States is now at risk of falling into the last category. The point being that the black line is actual growth, and the blue line is pre-crisis trend growth. You can see that not only is the black line not catching up to the blue line, it's actually getting farther apart, which is just another way of saying that our trend growth rate has declined. I would hope that it would go without saying that economic policymakers should use all available tools to minimize supply-side damage from the crisis. We need policies that support labor force participation and the development of skills, business hiring and investment, and productivity growth. Policies that are, for the most part, outside the remit of the Federal Reserve. Monetary policy can contribute by continuing to support the expansion as long as inflation remains consistent with our 2% objective and inflation expectations remain stable. Strong labor markets do seem to be averting some of the damage that might otherwise have become permanent. Improved matching is reducing the natural rate of unemployment. Potential workers are being pulled into the labor force by rising real wages and the recognition that jobs are becoming easier to find. Over a longer period, stronger demand should support increased investment, driving productivity higher. Moreover, as the economy tightens, firms have rising incentives to get more out of every dollar of capital and every hour of work. Real-time estimates of potential output are highly uncertain, forecasts of potential growth even more so. We can estimate the growth of the working age population reasonably well. Future levels of labor force participation are less certain, and least certain of all are forecasts of TFP. If the optimists are right, then there will eventually be another wave of high productivity growth driven by the truly remarkable evolution of technology. And that would mean, of course, higher potential growth, faster increases in living standards, and also a return to higher interest rates over time. What if the pessimists are right and productivity growth remains low for another decade or indefinitely? The consequences would include lower potential growth and relatively lower living standards, and our long-term fiscal challenges would be that much greater. Turning to monetary policy, the implications for monetary policy of these supply-side issues have been limited, but they begin to matter more as we near full employment. So for the near term, my baseline expectation is that our economy will continue on its path of growth at around 2%. To confirm that expectation, it will be important to see a significant strengthening in growth in the second quarter after the apparent softness of the last 2 quarters. To support this growth narrative, I also expect the ongoing healing process in labor markets to continue with strong job growth, further reductions in headline unemployment and other measures of slack, and increases in wage inflation. As the economy tightens, I expect that inflation will continue to move over time to the committee's 2% objective. So if the incoming data continues to support those expectations, I would see it as appropriate to continue to gradually raise the federal funds rate. Depending on the incoming data and the evolving risks, another rate increase may be appropriate fairly soon. Several factors suggest that the pace of rate increases should be gradual, including the asymmetry of risks at the zero lower bound, downside risks from weak global demand and geopolitical events, a lower long-run neutral federal funds rate, and the apparently elevated sensitivity of financial conditions to monetary policy. Uncertainty about the location of supply-side constraints provides another reason for gradualism. There are potential concerns with this gradual approach, however. It's possible that monetary policy could push resource utilization too high and that inflation could move temporarily above target. In an era of anchored inflation expectations, undershooting the natural rate of unemployment should result in only a small and temporary increase in the inflation rate. But running the economy above its potential growth rate for an extended period could involve significant risks, even if inflation does not move meaningfully above target. A long period of very low interest rates could lead to excessive risk-taking and, over time, to unsustainably high asset prices and credit growth. Macroprudential and other supervisory policies are designed to reduce both the likelihood of such an outcome and the severity of the consequences if it does occur. But it is not certain that these tools would prove adequate in a financial system in which much intermediation takes place outside the regulated banking sector. Thus, developments along these lines could ultimately present a difficult set of trade-offs for monetary policy. To wrap up for now, with the support of monetary accommodation, our economy has made substantial progress. My view is that a continued gradual return to more normal monetary policy settings will give us the best chance to continue to make up lost ground. Thanks very much, and I look forward to our discussion.
Fabulous. That's me. That's me. Thank you so much, Jay. We obviously have a very expert audience and a lot of people waiting to ask you questions, but if I could, I'd just like to pose a couple to start. Towards the end of your speech, you mentioned the idea of, I'm trying to find the exact words so I don't end up saying something wrong, the apparently elevated sensitivity of financial conditions to monetary policy. That leads me to two questions. First is, it's interesting to juxtapose that with an apparent diminished sensitivity of real investment to monetary policy. I mean, that seems to be the big uphill battle central banks have been facing for the last few years. Is there, given particularly your financial markets background, what do you think leads to this divergence between monetary policy seeming to have more effect on asset markets and less effect than in the past on investment?
Okay. So what I was referring to there, and there's so many different ways to try to relate changes in financial conditions to changes in expectations about monetary policy. But this was a statement based on one look, which is to look at the differences between forward expectations for rates in other advanced economies in the United States, and look at changes in that spread, and look at the effect that would have on the dollar. And it seems that that effect has been higher than expected. So by that particular measure, and that would explain some of the quite large move in the dollar since the middle of 2014. You're asking, though, about the tension between that and really low capital investment in the face of very low interest rates. So as I mentioned in my speech, we look at it in sort of standard accelerator model terms and other frameworks as well, and come pretty much to the view that low capital investment is explained largely by weak demand. Businesses don't have to invest because demand is weak. It's no more complicated than that. I would say also, though, based on my long career in dealing with private sector companies, if you put yourself in the seat of someone responsible for management of a company, they see weak demand. They can cut costs, they can buy back their stock, and they can make their numbers that way for a period of time. So investment is low, but it's a way for you to make your numbers without taking a lot of risk.
Right.
And if you think about where that takes you over a period of 10 or 15 years, is to kind of a hollowed out economy. So it's not a great trend. But we don't see a residual to explain, though, in terms of our basic framework for investment.
Great. And so secondly, you raised the issue of the dollar. Obviously, I'm not going to ask you to comment on any particular level or intervention, but just more broadly, we're being forcibly made aware of various other countries' concerns about the dollar, their reactions, other central banks to the dollar. In the same spirit as my last question, how do you think about the chatter sometimes that the Federal Reserve can't raise monetary policy as much as they would like, right, tighten monetary policy, as much as they would like, because the dollar effects are so large?
Well, let me begin by echoing your point that of course we don't have anything to do with managing the level of the dollar.
This is about transmission.
Right. I'm just getting that ritual disclaimer out of the way.
Absolutely.
In case there are Treasury people here who are watching. So I think what happened is, since the middle of 2014, financial conditions tightened significantly, and not through the traditional channel of interest rates. So in effect, we had to tighten less, is what happened. It's not to say that we can't tighten policy. The point is to tighten financial conditions, not to raise interest rates, right? So we do what we think is appropriate, and I think we have the freedom to do that. But we do have to take into consideration, conditions around the world, and one of many financial conditions we've got to evaluate is, of course, the level of the dollar.
Great. Thank you very much. I'm now going to open it up to our audience for questions and some very simple ground rules. Please wait to be recognized. If you're recognized, please identify yourself. Please pretend you are asking a question. If you do something that resembles a speech, I will cut you off. In practical terms, we have a traveling mic up here up front, which Chris is holding, and people towards the back can feel free to stand at the standing mic. Who would like to go first under that horrible threat I just issued? Right here.
So one question I had was...
Identify yourself,
Oh,
please.
sorry. Jonathan Pingle from BlackRock. So, the arguments for, caution and, facing the problems of, asymmetric policy response near the zero lower bound sound eminently reasonable as a, sort of a justification for proceeding gradually. However, trying to understand exactly what that means for the path forward, say, maybe one hike or two hikes this year, maybe 3 or 4 next year, or does that mean 2 next year? I mean, it's difficult to see out over the next 2-3 years how we interpret that relative to, a historical hiking pattern, which would have been, say, faster, or does this mean something incredibly slow? So, for example, just thinking about the dot plot, right, the median dots for 2017 have 4 hikes priced in. Now, how do you reconcile that with asymmetry and gradualism? I mean, is that gradual in your view? Does that incorporate the inability to respond to downside risks? I mean, how do we reconcile this gradualism with what we see in the dots? Is the dots gradualism?
Or as I would put it, do the dots matter at all?
So the dots really represent, as I'm sure you know, individual participants' estimates of appropriate monetary policy given and in consideration of a modal forecast. So I would say that anyone's ability to forecast much beyond the next few months is really not so great. Just the standard errors around pretty much everyone's forecasts, not just ours, are quite large. So the way to think about it is it's not a promise, it's not a statement of an intention, it's a statement of what someone would think monetary policy would be what would be appropriate given that modal forecast. And that's the only way to think about it. If you think about it as doesn't that sound like a lot? No, it doesn't sound like a lot if that forecast is realized and if other financial conditions are about as expected. So we had a conference about this in New York a couple of months ago. The challenges of communicating around the dots are substantial. People do tend to take them more as promises and sort of not see the conditionality. I'm not saying you're doing that, Jonathan, but they're not without challenges.
Very nicely put. Who would like to go next? Please, the gentleman there.
Thank you. My name is Carlos dos Santos. I'm the ambassador of Mozambique. I want to thank the Peterson Institute for providing the opportunity and also for this illuminating presentation. In your presentation, you mentioned, I would say, bypassing the political events. And I wanted to hear a bit more about the impact of politics here in the United States. This is an election year. What effect, what impact that would have on the economy? Because there was quite a lot of economics in the presentation. I understood most of it, but I mean, part of it, not most of it. I'm not an economist, but I wanted to understand the impact of the politics on the economy. Thank you.
So I'm now in my 5th year. I'm one day, frankly, into my 5th year at the Fed. So this will be my 3rd election cycle, my 2nd presidential election cycle, and I can say that politics plays absolutely no role whatsoever in our deliberations or in our decisions. So we, the focus inside the Fed is very much not partisan politics or elections. It's very much economic fundamentals, and so it can be very jarring to emerge from the Fed and talk to people who think of politics or think of economics in political terms, which I referred to earlier. So honestly, it has no effect. We announced a quantitative easing program in September of 2012. We just don't think about it. And I can say empirically I find that to be the case, not just the rhetoric.
Please.
My name is Jo Marie Griesgraber. I'm with New Rules for Global Finance. And I wanted to ask you, sir, about the hollowing out of the middle class in the United States and how that syncs with your observation that wages are rising and that the real level of employment is going up. How are we going to return the middle class to a demand engine?
Let me first echo that there's a ton of research that supports what you've just said, which is that it's really the middle skilled jobs that have suffered. David Autor at MIT has done a lot, many others have as well. So, and it seems to be partly related to globalization and partly related to the sort of the plateauing of U.S. educational attainment compared to our competitors. So it's a serious problem. It's not really a problem that's in the wheelhouse of monetary policy. We have one tool, which is monetary policy, and it supports demand at the aggregate level. It doesn't support distributional policies or policies that might provide training or might address all of the issues that you're talking about. Those are really matters for the elected branch, for Congress, and they are frankly more important than the management of demand, which is really what we're focused on. But it's not something that we can really play a role in, other than by maintaining stable prices and full employment.
Can I just follow up, though, on one piece of that? So you mentioned globalization and our relative competitiveness of the labor force. I think David Autor and many others would also suggest technology has played a role. But leaving that aside, clearly part of what you describe when you're talking about monetary policy, and any good central banker would talk about essentially how much you worry, as you said, that if we fall behind the curve, will inflation accelerate or will expectations become unanchored? Does it ever enter your discussions or your own personal views, more importantly, that labor really is weak now, that for whatever variety of reasons, labor just doesn't have the bargaining power it did, and so maybe the risk of an inflationary spiral is less? Or is that just not something that would come up in a discussion?
It comes up indirectly. It's if you look at the relationship between slack in the economy and price inflation, and then look at the relationship between price inflation and wage inflation, both of those relationships have weakened very substantially over the past 20 years. So, to say it differently, wage inflation, which has been weak, no longer affects price inflation as much as it used to, and price inflation is no longer as responsive to the economy getting tight. So you can be at full employment and you don't see much inflation. This is very different from the world that we grew up in, with wage price spirals and such. So all of that is, I think, consistent with a world in which companies maybe substitute capital for labor, and labor's share of income goes down. And it's not something we can. It's kind of in the numbers, but it's not something I feel like we can target directly with our policies.
Great. At the back, Mike, and then over there.
Hi, Mil Arcega from Voice of America. Thank you for your comments, sir. I've got sort of a three-part question here, and the first one is are we now seeing a coordinated effort by members of the Federal Reserve to signal a possible rate hike soon? The second would be, how would you vote in June 15th for a rate hike in June? And what do you see as the risks of not acting quickly enough?
Okay. Concerted effort, no. Adam will confirm that we scheduled this speech. I think it was
2.5 months ago, 3 months ago?
More than that even. It might have been late last year. It was a while back. So there was no thought at that time. It just happens to be now, and that's a coincidence. You don't see. I think I'm the first board member to say anything about this. Actually, a lot of the bank presidents have been talking, and some of the other board members will be speaking in the next week. But no. How I would vote. So the great thing is I don't have to decide until June 15th, and I really think you discard the opportunity to evaluate incoming information when you decide too early. So I really do legitimately and not just in theory, think that there's important incoming data, not just about the real economy, but about the balance of risks that will come in between now and then. So I honestly don't know. The risks of waiting are frankly not so great. This doesn't feel like an economy that's that's bubbling over or threatening to break into high inflation. At the same time, I think you have to balance. Really, I think the right plan, as I said, is a gradual set of rate increases over time, and you've got to balance the risks of the relatively modest risks of running the economy too hot and then having to move more sharply, perhaps causing a recession. And you've got to take into account the fact that we really are we've made tremendous progress. We're close to full employment. And I think, again, you don't want to wait too long, but neither do you want to be in a hurry.
Rate hike in June?
Will you please? Doug and then Jason, and then we'll go to the back. Could you go to the back?
Thanks. Doug Redeker, International Capital Strategies. Jay, sort of a two-part question. You mentioned the international implications and how those sort of weigh on your thinking, and I just wanted to ask you to expand on that. And then one thing that you didn't mention is the concept of financial stability. And again, a broad question for you. Just how do you think about financial stability concerns as they relate to monetary policy and the dual mandate?
So on international concerns, I was rereading a paper by Barry Eichengreen from 2013, which some of you may remember, where he talked about the history of the Federal Reserve and its relationship to international concerns. And it does sort of come in and out of focus. I think and here lately, I think our public communications have had more than the usual amount of communication in them about international factors. And I think that's simply because of the situation we're in, which is U.S. demand is stronger. The U.S. is in a position to consider removing accommodation gradually, and other major economies are not in that position. So we stand out, and I think global growth and inflation are weak. So it's just a time when those things are particularly important for us. In terms of financial stability, you may have seen in the last set of minutes, if you really don't have that much to do, you might have read the minutes and seen that we had a long scheduled discussion of financial stability and monetary policy at the last meeting. And I think the conventional wisdom is generally that that macroprudential and other supervisory and regulatory tools are the first line of defense against financial instability, and that monetary policy is really for stable prices and full employment. I think it's not easy for many, including me, to be particularly comfortable with that formulation, particularly at a time when, the scenario is the one I mentioned in my speech, which is, what if it's monetary policy that is over a long period of time? What if rates have to stay lower than we even think they will for a long period of time? Upward pressure on asset prices and on credit growth, and it's because of monetary policy. So there may be a tension there between the dual mandate and financial stability. We don't see that today at all. The last thing I'll say is, at the board and in pretty much everywhere, you have a heightened focus on issues of financial stability since the crisis. And it's a very, very deliberate, focused effort to build up the core of the system. And I think it's made, frankly, excellent progress, and more to do on that.
Great. Jason here, and then we'll go to the back right.
Jason Cummins from Brevin. I wanted to turn your attention back to your discussion of inflation expectations, which you briefly touched on. I detected, although I'll have to go and read the speech carefully, somewhat a greater measure of concern about risks to the downside on inflation expectations in this speech compared to some of the other discussions I've seen recently, and that certainly reflects some of the same concerns I've had about the same subject. In your mind, when you think about normalizing monetary policy, as you described, you're trying to tighten overall financial conditions. How do you explain to the public, as you're removing accommodation, that you're still concerned about maintaining the sanctity of the nominal anchor when the public, it's not clear, there's no one public out there, but in various different cuts at the data, whether it's the surveys or what we're getting from the markets, there seems to be some concern about whether inflation expectations are as stable as they have been in the past. It was never going to be an easy job to raise rates and get inflation to be going up at the same time. We've never done that in monetary policy before in the United States. So what do you do alongside the normalization process to convince people that inflation will be going up and the Fed will be concerned about that without promising an overshoot, without just repeating gradualism over and over again?
So it starts with where inflation is right now, and core inflation is at 1.5% and is probably being held down by 30 or 40 basis points by the effects of the strong dollar and a little bit by the effects of lower oil prices. So if you add 30 or 40 basis points in, you're at 1.8, 1.9. So, pro forma, and in my former world of corporate finance, pro forma-ing was a contact sport. Pro forma, you're close to 1.8, 1.9. You're not so far from 2%. And in theory, all you've got to do is wait for all things held equal for inflation to return to that level. So that's why I have some comfort in moving at this time, is that I don't think on an underlying basis we're all that far. I also, we've spent time on this. The issue with inflation expectations, if you take break-evens, these are market-based, and there's a lot of decomposition of what's going on there. And many make the case that it's really about liquidity premia and really not about people's expectations. And I really don't want to sound like I just accept that at face value, and I don't. I mean I get that, but when inflation when 5-year forward inflation expectations are down as much as they've been since the middle of 14 and stay there, then I think you should be worried about that. And I think it's something to focus on. Again, I do think that inflation, I would still say they are anchored, inflation expectations, but I would say that it's important that the public see, as you've suggested, that we are committed to returning inflation to 2% and keeping expectations anchored.
Great. We have quite the lineup at the back, Mike, so let's go for a couple there, please.
Hi, thank you very much, Mr. Powell, for being here. This is an excellent panel.
Who are you, please?
I am from Anadolu Agency. My name is Gülbin. I would like to ask you a question regarding the data-dependent monetary policy. So we know that the effects of monetary policy comes with lags. It takes time to see the outcome after the decision. So that's why we hear that the monetary policy should be forward-looking. And at the same time, we hear the FOMC members emphasizing the data dependency in every opportunity they get. So I'm just curious how the Fed can achieve forward-looking monetary policy by looking at past data as their main factor in deciding, the monetary policy. And also, my second question is, last year this time we were talking about the possibility of a June rate hike, and it didn't happen. The Fed had to wait until December, and I was just curious, what is the likelihood of having a deja vu this year, and what can cause it? Thank you.
Should have stuck with one question.
Just do me a favor, give me a 10-word, remind me what your first question was.
The first question was, how can you be data dependent and be forward-looking monetary policy?
Right. Okay. So, thank you. As you probably know, each member of the FOMC, each participant, all 17 of us, gets to write down a forecast, a 3-year forecast of the economy, and then write down what we think appropriate monetary policy is to achieve that path for the economy. So it is very it is forward-looking. Policy is always forward-looking, really, and it's dependent on incoming data too, because that tells you the state of the economy. That tells you whether it confirms or doesn't confirm your expectations going forward. But policy is of course completely forward-looking. In terms of what will happen, I don't have any projections for you. I've told you how I think about the problem and what I expect will be appropriate given what I expect for the economy and for risks. And if it doesn't pan out, if the conditions that I've laid out don't happen, then I suggest the committee could move faster or slower.
Very good.
Thank you.
Second question at the back, then we'll come to the front. You can put down your hand.
Jeremy Cohen-Seton, UC Berkeley. In your presentation, you showed us the decline in the growth rate of potential GDP. You also mentioned the decline in the neutral rate of interest. And so I was wondering how much of that decline in the neutral rate of interest do you think is linked to to the decrease in the potential growth rate of GDP?
So I think they're fairly closely linked. You know, I don't have all the potential models in my head this afternoon, but you know, I think it's almost a one-for-one decrease in the neutral rate from estimates of potential growth going forward. Certainly close to that.
Yep. Over here, please.
Thank you, Jay. So I wanted to ask you...
Identify yourself,
Sorry,
please.
forgive me. Krishna Guha, Evercore Partners. I wanted to ask you about the upcoming Brexit vote and how it influences how you think in the near term about your policy choices and the benefits of making a decision at one meeting relative to another meeting. Is it your view that if the odds of a Brexit vote going in favor of exit were declining and markets were therefore responding in a risk-positive way in the run-up to your meeting, that would essentially allow the committee to set aside that consideration and focus only on the domestic data and so forth? Or would you need to see that risk fall to an immaterial level in order to be comfortable making a policy call at the next meeting?
Let me piggyback on Krishna Guha's question. One of the things coming out of the spring IMF World Bank meetings, G7, G20, Fed, all this, was some repeated statement that Brexit was a systemic risk. Now, don't get me wrong. I love the United Kingdom probably as much or more than any other American, but I've never understood how this becomes a systemic risk. So, what in your view, why is that
Okay.
a concern?
I would, taking Krishna's question for a second, I would break it into two questions. The first of which is, how does the vote come out? And the second of which is, in the event of a leave vote, what are the consequences for financial conditions, for economic conditions, and ultimately for the U.S. economic outlook? I think it is possible to, it's still some weeks until our decision on June 15th. It is possible that we would learn important information between now and June 15th on the first question. I don't really think it's possible we would learn much about the second question, which kind of goes to Adam's point, and that is, there's a modal expectation maybe that there would be some financial dislocation, but it wouldn't necessarily, in my view, I don't think you're looking at a systemic event in the sense of something that could lead to broad contagion. I don't see that. I do see, though, the possibility of a real hit to economic growth, both in the UK and in the EU. So if you boil that all together, again, it's don't have to decide this today, and I certainly haven't decided, but I can imagine the upcoming Brexit vote as presenting a factor in favor of caution about raising rates in June.
Interesting. At the back, please.
Thank you. I'm Gonzalo Garcia from the Embassy of Spain. I think from your analysis, Mr. Powell, there seems to be a disconnect from the real side and the financial side. So there's capital substitution from labor, but we don't see capital deepening and labor productivity growth. And don't you think that perhaps monetary policy might be contributing to the dearth of investment and to that kind of situation, allowing the companies, as you say, to make the numbers without investment?
I do not think that is the case. I think that monetary policy is supporting demand in the face of still significant risk aversion and headwinds in the wake of a global historical economic event called the global financial crisis and the resulting recession. I think we're still digging our way out of that. I think it's still echoing down the years, and I think it will do so for some time. So I don't really think, I think monetary policy on net is contributing to the recovery, not holding it back.
Thank you. Thank you. Another question from the audience?
Dave Stockton, Peterson Institute. I want to return to the longer run themes of your remarks and this observation that we're seeing slower potential output growth, and that's probably been associated with a decline in either the equilibrium or natural rate of interest. Do you think, given that, and then the implication that we're going to be running in a low nominal interest rate environment for quite some time, if that's going to persist, Is it time for a more serious reconsideration of the 2% inflation objective?
I think in theory and in, that is a logical margin upon which to adjust. It's not at all something that we're considering at this time, and I frankly think that Chair Yellen took that question on in great detail. Dave, you may remember in a speech, I want to say late last year, about inflation dynamics, and came down strongly that when you embrace an inflation target and expectations get deeply anchored, as they clearly are now, the costs of trying to move that are uncertain and potentially high. So it's not something that I would be looking at doing in the near term.
It's interesting. When I got to co-author with Bernanke, Laubach, and Michigan a book on inflation targeting now, a while ago, then future chair Bernanke signed on to passages in the book that indicated the inflation target should be movable, that we would expect it to move as conditions changed. Now, I have since said publicly, and I won't presume to speak for any of my co-authors, that was a mistake on our part, not from a normative sense that we were wrong, but that we were foolish. We should have realized, like an exchange rate target zone, that once you put in the number, people are very scared to get off it. But that's obviously a very different place than what you're citing Chair Yellen's speech, saying that it would be bad to move it inherently. And I mean, I'm not trying to press you on this. It's just it's very striking how ex post the profession seems to have decided that it is risky to move an inflation target, where ex ante the inflation targets were designed to be reset.
Yeah, I mean, again, in her telling it and many people's telling of it, it took many years to get inflation expectations settled down and anchored. And when they weren't, we knew what would happen. There would be a shock and inflation would go up. They would just move around. So that's a very costly thing. Getting them anchored was a costly thing and took a long time. And moving them around is something that, it kind of undoes the whole psychology of them being anchored, and you have to go through that process again. I get that, but at the same time, that was all done in a rate of 4 to 5% nominal federal funds rate in equilibrium. This is not that world.
Right. Thank you. Question here, please.
Thank you, Angel Ubide from Goldman Sachs. In the last couple of years, we have seen an increase in the amount of information that the Fed communicates to markets with the dots and all the rest of the data in the SCP, an increase in the speeches and in the content of the speeches coming from FOMC participants. And yet, if you take, for example, the reaction of the markets to the March meeting or the reaction of the markets to the minutes of the April meeting the other day, and you do a couple of fancy calculations, you can see that there were very large surprises from the point of view of the market reaction. So do you worry about this? And what are we collectively missing in terms of understanding the Fed's thought process and the reaction function that has changed? Or is just a fact of life? Thanks.
So what's the last part?
Is it just a fact of life and we have to live with it?
Yeah. So I have thought about the question of are we doing too much communication, and also about the difficulty of doing less, which there's not much track record of people reversing gears on that. So I think my main point would be that you're still at a time of extraordinary accommodation, and decisions are highly fraught and attract a lot of attention. And that's part of the issue. Is this would be the next interest rate increase will be the second one, and it'll be important, and it just gets a lot of attention. I will say though that the March SEP, as I'm sure aware, had 2 rate increases in it this year. I think any number of bank presidents were out saying, that two rate increases, and things have probably gotten a little better on balance since March. Two rate increases is what the committee thought. So yes, the market was apparently surprised by the minutes, but I think it was there in a way. It's not easy to, nor is it essential that the market understand every word that we do.
Thank you for that. Well said.
We need to do what is right for the economy and let the chips fall. Within reason, we need to be doing that, and not focusing too much on short-term reactions.
Please tweet that. At the back mic, please.
Jacob Kierkegaard from the Peterson Institute. I first want to commend you for actually putting up the employment rates data in your presentation, because I think, if I'm not mistaken, the Fed mandate talks about maximizing employment, and your data clearly shows that the situation is abysmal. I mean, there is no other word for it, in my opinion. So I guess I just would like to have your comment on that. I mean, when you correctly point out that prime age employment in the United States is below that, or participation is below that of a number of European countries, that is historically unprecedented. So how do you basically how do you square that with a policy outlook that suggests that you are close to meeting your employment mandate? I would suggest that you are pretty far from it.
Well, some of this is addressable by monetary policy, and some is not. Decline in participation by prime age males has been a trend for decades now, and what we can do is support. As I suggested we should. We can support economic activity with accommodative monetary policy as long as inflation expectations are stable and inflation is close to target. So we can do that, and I'm pretty confident we will do that. That's not going to turn around these long-run trends. It's not. As I mentioned in my speech, there are things that need to be done on the policy side, much more important things by Congress, frankly, and maybe at the state level, that we don't have responsibility for. Now, we don't do fiscal policy, and we don't do partisan politics, so I don't want to roll out my personal suggestions here today, but there's a lot that can be done. If you look at all of the margins of potential growth and productivity, there's a lot to do in terms of education, in terms of encouraging labor force participation rather than punishing it for those who, for example, are receiving benefits from the government. There are things to be done with TFP, with basic research. They're just every one of those areas has things that can be done, and which is why the focus on the next interest rate increase, it's just not that important compared to the long run potential growth of the economy, and that's what we ought to be talking about.
Unless you're a Fed governor.
Unless you're a Fed governor, yeah.
Anyone else? This is a rare opportunity. Okay, you get a second shot. Yeah, if everyone else wimps out, you get a second.
Yeah, I wanted to ask a longer run question there rather than just the short run question before, which is, when you look at the market implied path for Fed rates, I mean, going out a very, very long way with, forward real rates and so forth, and compare that with the sort of trajectory that is envisioned, broadly speaking, by most participants in the SEP, even allowing for some difference between the base case outlook in the SEP and a sort of risk-adjusted path priced into markets, it seems like the market is saying that the neutral rate is lower today than you think it is, and it's going to rise much more slowly than you expect it will rise over the coming years. That's the only way I can really make sense, not of a June versus July type debate, but of this broad difference going out several years. What makes you and your colleagues confident that, given the experience of the last few years, where we've serially over-forecast the recovery in the natural rate, what makes you confident that the broad SEP worldview is a reasonable base case as opposed to the market implied view?
And to make you feel better before you respond, I've already been hoisted on my own petard on this. When I was on the monetary policy and the Bank of England, I kept saying, you can't believe these crazy low productivity numbers. It's not like every worker in Britain woke up with their left arm missing. This doesn't make any sense. But then we get to year 6 or 7 of really low productivity numbers, and I had to start saying, well, maybe it's not going to pop back up. So I mean, just to say, this is genuinely hard, and lesser beings like me have certainly screwed this up. So what do you think?
So you're right. Of course, there is a significant gap between the committee's most recent dot plot median expectations and between what the market's saying. I haven't looked in the last few days, but I would imagine it's closed just a tiny bit. And that can be a function of a couple things. One would be of course, there's term premium as you get farther away from zero, which would account for some of the difference. You also mentioned the difference between what we're showing, the mode, and that's really a risk-weighted mean. So there seems to be, for good reason, people seem to be looking at long duration securities as a hedge against downside cases, because they are very nicely correlated with those outcomes. So you're seeing more of that, and that explains a part of it. Another part of it has to be implicitly or explicitly a lower estimation of the endpoint, which is at the end of a cycle, which is our start. So none of that is in the nature of making me comfortable with the difference. And it's hard to know. I mean, we have to do our jobs. I've got to do my job, and the market has to do its job. And I'm one who is inclined to think that one should listen to what the market is trying to say. Not that the market is always right, but that there may be something worth saying. And I think those are some of the explanations, and we'll just have to see.
Great. Is anyone else? Yes, please.
Thank you very much. My name is Ken Nibayashi from the Embassy of Japan. As you know, as the Federal Reserve, you are talking about raising the interest rate, whereas, as you know, the Bank of Japan introduced the negative interest rate, and so did the ECB. And these differences in monetary policy are said to be the leading causes of the stronger dollars. So my question is, to what extent, if any, do you take into consideration of monetary policies of outside the U.S.? And more generally, to what extent do you take global economic outlook, including the slowdown of the Chinese economy, into consideration? Thank you.
So we're charged with stable prices and maximum employment in the U.S. economy. That requires us to take into consideration all the factors, both financial and real, that would affect that. And certainly in this environment, as I mentioned earlier, that does include financial developments around the world, and the fact that other major central banks are adding accommodation at this time. So all of that is under consideration. I think international concerns, as I mentioned, are particularly high here in the last year or so. But that's simply because I think of the divergence of growth patterns, really, between the U.S. and big parts of the rest of the world. So, but I think our job, we're not assigned with anything but stable prices and maximum employment in the United States, and ultimately that's our focus. But of course, you can't do the job without engaging with all the global factors that you mentioned.
Well, we had a bit of an exchange about whether there's been, for whatever reason, too much communication out of the Fed, but such a calm, clear, sober, and informative speech certainly is the kind of communication we want to retain from the Fed. So on behalf of the American public, but also on behalf of the Peterson Institute, let me thank you very much for your time today. This was terrific.
Thanks again, Adam. I really appreciate it. Thank you.